It has officially begun. The most sophisticated high-stakes trap in the history of the silver market was just sprung. And if you are looking at the price action on your phone, you probably think the rally is over. You see the red candle, you see the rejection at 85s, you see the mainstream media screaming double polars, double top, and bubble burst. But let me tell you something that the talking heads on CNBC will never tell you. That was not a sell-off. That was a setup. Yesterday, silver touched the critical 85 level, the Maginot line, that the banks have defended with their lives for decades. And then, in a matter of minutes, the price collapsed. It fell $3, then $5. The technical damage looks catastrophic. The charts look broken. This is exactly what they wanted you to see. We are witnessing a classic bear trap executed at the sovereign level. The bullion banks, the entities that are naked short billions of ounces of silver, knew they couldn't stop the momentum with normal selling. They ran out of physical ammo weeks ago. So they switched to psychological warfare. They engineered a fake breakdown. They used the ghost week liquidity vacuum to paint the tape. They triggered a cascade of stop-loss orders from the weak hands, the retail tourists who just arrived last week. They wanted to create maximum fear. They wanted you to believe that $85 was the top, so that you would panic and sell your physical ounces back to them. But here's the smoking gun that proves this was a trap: the volume divergence. While the paper price was crashing on the COMEX, the physical buying in the wholesale market accelerated. We tracked the block trades and the exchange for physical EFP data. As the price dropped from $85 to $80, the commercial entities, the smart money, were backing up the truck. They were buying the dip with both hands. They used the liquidity flush to fill their order books without driving the price to $100 immediately. They tricked the retail speculators into selling, and they stood there with buckets catching every single ounce. This rejection at $85 wasn't a sign of weakness, it was a sign of desperation. It was the last gasp of a dying cartel trying to shake you out before the real move begins. They know the shortage is real. They know the vaults are empty. They know that once we clear $85 for good, there is no resistance until 3 digits. So they set a trap. They slammed the door one last time. If you sold yesterday, you fell for it. If you held, congratulations. You're about to be rewarded for seeing through the illusion. The trap has been sprung, but the banks caught the wrong prey. They were trying to trap the longs, but they have inadvertently trapped themselves. They are now shorting into a hole, adding leverage to a position that is already underwater. They have compressed the spring even tighter. When this trap fails, and it will fail, likely within days, the snapback will be violent. We are not looking at a recovery, we are looking at a vertical melt-up. The mechanics of the deception, spoofing, and the gamma wall. To truly understand how this trap was engineered, we have to go deep into the plumbing of the derivative market. We have to talk about spoofing and the gamma wall. Most people think the price of silver is determined by buyers and sellers meeting in a free market. That is a fairy tale. The price is determined by algorithms fighting over leverage points. Yesterday, as silver approached $85, the market makers, the big banks, were facing a catastrophic scenario. They had sold millions of ounces worth of call options with an $85 strike price. If silver stayed above $85, those options would go in the money. The banks would be on the hook to deliver metal they do not have. This created a gamma wall. As the price ticked closer to $85, the bank's risk exposure went parabolic. They had 2 choices: buy futures to hedge, which would drive the price higher and bankrupt them; manufacture a crash. They chose option 2. Here's how they did it. They used spoofing. This is an illegal but widely used tactic where a trader places a massive sell order, say 5,000 contracts, just above the current price. They have no intention of actually selling. They just want the algorithm to see the order. The high-frequency trading, HFT bots, see this massive sell wall and think, oh no, there is huge supply at $85. So the bots front-run the sell order. They dump their positions instantly. This creates artificial selling pressure. The price starts to drop. As it drops, it hits the stop-loss levels of the retail traders. These are automatic sell orders placed by people trying to protect their profits. Snap, snap, snap. The stops trigger like dominoes. The selling accelerates. The price plunges from $85 to $80 in minutes. And then, and this is the critical part, the banks cancel their spoof orders. They never actually sold the 5,000 contracts. They just flashed them to scare the robots. Once the price has crashed and the retail traders have been flushed out, the banks step in and buy back their real short positions at a lower price. They profited from the crash they engineered. This is the mechanics of the trap. It was a digital heist. They stole value from the paper holders to save their own skins, but they made a fatal mistake. They forgot about the physical market. While they were playing video games with the paper price, the physical market did not react. Dealers did not lower their premiums. Refiners did not lower their prices. The real price of silver stayed at $85, even while the paper price flashed $80. The disconnect is now visible to the naked eye. The trap only works on people who trade paper. It does not work on people who stack metal. They tried to spoof a shortage, but you cannot spoof a 1,000-ounce bar. The gamma wall is still there. They defended it yesterday, but they used a lot of energy to do it. They weakened their own position. The next time we approach 85, which could be tomorrow, they won't have the ammunition to spoof it again. The wall is cracking. While New York was busy setting traps and painting the tape, something incredible was happening on the other side of the world. Something that exposes the $85 rejection as a complete fabrication. We need to talk about Shanghai. We have been tracking the arbitrage gap, the price difference between silver in Shanghai and silver in New York. Historically, these prices move in lockstep. If there's a difference, arbitrage traders buy in the cheap market and sell in the expensive market until the gap closes. But right now, the gap is not closing. It is blowing out. Yesterday, when COMEX silver was being smashed down to $80, Shanghai silver was trading at a premium that converts to nearly $90 per ounce. Think about what that means. The Chinese market, the market that actually consumes the metal for industry, is saying silver is worth $90. The American market, the market that trades paper bets, is saying silver is worth $80. This $10 gap is the truth serum. It tells us that the sell-off in New York was artificial. If there was truly a surplus of silver, if the price truly deserved to fall, then Shanghai would have fallen too. But it didn't. China is acting as the black hole for global silver. They are using this suppression to drain the West. Every time the banks in New York smash the price, they are effectively subsidizing the Chinese industrial complex. They are putting silver on sale for their biggest geopolitical rival. We are seeing reports of massive physical flows moving from London and New York vaults to the east. The loadout data from the COMEX shows inventory leaving the registered category, available for delivery, and disappearing into private vaults or leaving the country. The trap at $85 was designed to scare you, but it didn't scare China. They saw the price drop and said, "Thank you." They increased their buy orders. This creates a Shanghai put under the market. The price cannot crash for long because the arbitrage gap becomes too profitable. If silver drops to $75 in New York while Shanghai is at $90, every trader on Wall Street will buy New York and sell Shanghai. The buying pressure from the arbitrage alone will force the price back up. The banks are fighting a war on two fronts. On one front, they are fighting the speculators and the gamma wall. On the other front, they are fighting the Shanghai vacuum. They might be able to spoof the speculators, but they cannot spoof the arbitrage. The $85 rejection was a Western illusion. The Eastern reality is that silver is already trading near triple digits. We are just waiting for the exchange rate to catch up. Now, let's pivot to the real victims of this trap. It's not just the retail traders who got fooled. The industrial supply chain is now in a state of absolute panic. The rejection at $85 sent a terrifying signal to the procurement officers at Samsung, Tesla, and LONGi Green Energy. These companies operate on a just-in-time inventory model. They rely on the market to deliver metal exactly when they need it. They saw the volatility yesterday. They saw the price smash. And contrary to what the banks wanted, it didn't make them comfortable. It made them realize the market is broken. We need to talk about TOPCon solar technology. This is the new standard for solar panels. It uses 50% more silver than the old technology. The solar industry is currently consuming silver faster than the mines can produce it. We are in a structural deficit. When the price crashed from $85 to $80, these industrial buyers didn't step back. They stepped in. They shifted from just-in-time to just-in-case. We have intel that major industrial users placed market-on-close orders yesterday evening. They swept the floor. They bought physical metal at the discounted price, not to trade it, but to hoard it. This demand is price inelastic. The cost of silver in a solar panel is maybe $20. If silver goes to $100, the panel costs $25 or more. It doesn't matter. They cannot stop the assembly line. The cost of stopping production is millions of dollars an hour, so they will pay any price. The trap at $85 has backfired because it cleared out the paper hands, speculators, but transferred that inventory to the diamond hands, industry. The speculators might sell if the price drops again. Industry will never sell. They will consume it. That silver is gone forever. It is melted into paste and painted onto a silicon wafer. It is removed from the ledger. The banks have inadvertently tightened the market. By trying to scare the tourists, they gave the metal to the entities that will never give it back. They have deepened the black hole. We are also hearing whispers of force majeure from the refineries. They are struggling to source 1,000-ounce bars. The miners are holding back supply. Why sell at $80 when the volatility suggests $100 is coming? The miners are joining the strike. The $85 rejection was supposed to loosen the market. Instead, it froze it. So what does this trap mean for you, the physical stacker? It means we are entering the unobtainium phase. The disconnect between the spot price and the street price is about to become comical. The banks might be able to paint the chart to show $80, but try to buy a monster box of Silver Eagles today. You will see the reality of the trap. Out of stock signs, premiums exploding. Dealers are terrified of replacement cost. If they sell to you at the smashed price of $80 and the market snaps back to $90 on Monday, they lose money. They cannot replace the inventory, so they protect themselves. They widen the bid-ask spread. They go bid only. We are witnessing the spot price becoming a ghost number. It is a reference point that nobody can trade at. It is a lie agreed upon by the banks. The real price is discovered in the physical market, and the physical market ignored the $85 rejection entirely. If you are waiting for the price to drop further to buy, you are walking into the second part of the trap. The first part was to get you to sell. The second part is to make you wait for a lower price that will never come. While you are waiting for $70, the premiums will go to $15 over spot. While you are waiting for the perfect entry, the sold out signs will go up. You will be left holding fiat currency, which is losing value every second, while the real asset becomes unobtainable. The trap at $85 was designed to shake you out. Do not let it. The only way to win this game is to not play by their rules. Their rules say, panic when the line goes down. Our rules say, buy when the line goes down. Buy when the line goes up. Never sell for fiat. The window to accumulate is closing. The supply chain has snapped. The trap has failed to break the physical sentiment. So, here is the verdict. The $85 rejection was a lie. It was a desperate algorithmic illusion created by a cornered animal. The banks are trapped. The gamma wall is cracking. The Shanghai vacuum is sucking the vaults dry. The trap fooled the algorithms. It fooled the weak hands. But it didn't fool us. Where do we go from here? The end game is clear. The short squeeze is inevitable. When the banks finally give up, when they stop spoofing and start covering, the price will not go up in a straight line. It will gap up. We will see $5 gaps overnight. We will see limit up opens. If the physical market is becoming unobtainium, where does the smart money go for leverage? We rotate into the miners. The $85 rejection is the best thing that could have happened for the mining stocks. It kept the valuations low for one more week. At $80 silver, miners are printing money. Their margins have expanded by 1,000%, but Wall Street is still pricing them as if silver is $25. This is the miner pivot. This is the opportunity of a lifetime. We are buying the unhedged miners, the ones with leverage to the spot price, the ones in safe jurisdictions. We are positioning ourselves before the Q1 earnings reports come out and blow the lid off this sector. And finally, the exit strategy. We are not holding forever. We are watching the gold to silver ratio. Right now it is around 50:1. When it hits 31, we wake up. When it hits 15:1, we swap. We trade the volatile silver for the stable gold. We lock in the purchasing power. The trap was a gift. It gave us one last chance to load the boat. Do not squander it. Subscribe to the channel. We are tracking the gamma wall and the Shanghai premium every single day. We will tell you when the next fake out is coming. The banks tried to fool everyone, but they didn't fool the stackers. Hold the line. Class dismissed.